Have you ever stopped to think about what really moves a stock price? I mean, yeah, we talk about earnings and fundamentals, but what if a huge piece of the puzzle is just a vibe? A collective feeling online? Well, we're going to dive into that because some fascinating new research gives us a front row seat to the psychology of the market as it happens.
You know, this idea isn't new. That's Nobel laureate Robert Shiller talking about the dot-com bubble way back in 2000. It's the classic example of what's called herding behavior. The idea that investors, at a certain point, just stop doing their own homework and start following the crowd. Sometimes right off a cliff. It's a powerful reminder that markets are made of people. And people, well, we're not always the rational creatures we think we are.
So for the longest time, this whole field of market psychology was squishy. It was something you could only really identify in the rearview mirror, after a bubble had already popped. But that's all changing. What if you could literally watch the herd forming, live, one online comment at a time? That's the exact question this new study set out to answer, using the trail of digital breadcrumbs we all leave online.
To really get why this is such a big deal, we got to take a quick trip back in time. Because financial history is just littered with examples of moments where raw emotion completely took over.
I mean, think about it. You had the dot-com boom and bust, the total craziness in the housing market that led to 2008, the sheer panic and volatility when the COVID-19 pandemic first hit. And this isn't just ancient history. A single fake post on social media today can spark a massive market swing in a matter of minutes. The pattern is pretty clear. Human psychology isn't just part of the market, it's a huge disruptive force.
Okay, so if we know these emotions are a big deal, how on earth do you measure them? This is where the research gets really, really cool. Instead of looking at charts, the researchers went straight to the source, the online stock forums where investors hang out.
First off, let's just lock in this key idea, herding behavior. It's basically FOMO, fear of missing out, for your portfolio. It's when investors start ignoring their own research and just start doing what everyone else seems to be doing. The crowd's actions become the only signal that matters.
And this is the absolute game changer. Every single post, every comment, every to the moon emoji and buy the dip rally cry, it's all a data point. For the first time ever, we have this massive public transcript of investor psychology unfolding in real time. Now, here's where the researchers got seriously clever. They realized you can't just look at whether a post is positive or negative. You have to separate the feeling from the intention. They called this sentiment versus stance. So for instance, someone might post, "Why won't this stock drop? I really want to buy it." The sentiment seems positive, right? Words like want and buy, but the stance is actually bearish. They want the price to fall. This little distinction is basically the key that unlocks their whole analysis. It's brilliant. So to put this theory to the test, they needed a perfect laboratory, a place with just the right mix of tech, investor behavior, and online chatter. And they found it in the Taiwanese stock market. So why Taiwan? Well, it was kind of the perfect storm. For one, it's a tech-heavy market, and tech stocks can be pretty volatile. It also has a ton of individual retail investors who are super active on these online forums. And the real kicker, it had just switched to a new high-speed trading system, which let the researchers match online posts to market moves with insane precision.
Okay, so here's the play-by-play. First, they got their hands on a full year of mind-bogglingly detailed trading data. We're talking every single trade, tick by tick. At the same time, they scraped almost 300,000 posts from Taiwan's biggest stock forum. Then, and this is the magic part, they used AI to analyze the sentiment and the stance of those posts every 15 minutes and just laid that information right on top of the real-world trading data. It's an incredible way to see the direct line between conversation and cash.
All right, so the stage is set. The data's crunched. They've linked the digital chatter to the market's heartbeat. The big question is, what did they find?
The number one takeaway was crystal clear. It's real. All that chatter online isn't just hot air. Both the emotional feeling, the sentiment, and the market outlook, the stance, had a direct, measurable effect on how investors behaved as a group. What people were saying online was actually pushing the market around.
But of course, it's never that simple, is it? The next logical question is, does this affect everybody the same way, or are some people more likely to jump on the bandwagon than others?
And this is where they found the first big surprise. You'd probably guess that the everyday retail investors would be the ones most easily swayed by the crowd, right? Well, take a look. It was actually the domestic professional fund managers, the investment trusts, that showed the most herding behavior. Individuals were right in the middle.
And the most independent? Foreign institutions, who are probably less tuned in to the local chatter and more focused on the global fundamentals. It's a wild finding. Being a pro doesn't make you immune to the local echo chamber.
Okay, so we know who's doing the herding. But the next piece of this puzzle is, where does the herd tend to run? Does this happen evenly across the entire market? Turns out, nope.
The researchers broke it down by industry, and a super clear pattern emerged. The fast-moving, high-buzz electronics sector, it was extremely sensitive to swings in public mood. But then you look at more stable industries like finance or the semiconductor industry, which tend to be dominated by big institutions, they were way less influenced. It just goes to show that the type of industry and who owns the stock can either crank up the volume on online chatter or tune it out.
So let's bring this all home. We've got all this data, all these fascinating findings. What does it actually mean for us? Why should anyone who invests today care about the digital herd?
Let's just boil it down. 1. Online talk is a real measurable force. It's not just noise. 2. That little difference between how someone feels and what they think will happen is absolutely critical. 3, and this is a big one, the pros are just as likely to follow the herd as anyone else, maybe even more so. 4, this effect is way stronger in flashy sectors like tech. And finally, it proves that nobody, not even the biggest players, is immune to crowd psychology.
And look, while this study was zeroed in on Taiwan, the lesson here is universal. This is basically a blueprint for understanding a whole new kind of risk, and maybe even opportunity, in any market in our hyper-connected world. It's like we can finally see the invisible psychological currents that are always moving beneath the surface. So I'll just leave you with this to chew on. We spend so much time building these complex models, looking at spreadsheets and economic data, but if the collective mood of an online forum can measurably move a stock, what are we really trading? Are we trading the value of a company, or are we just trading the feelings of the crowd? It's a question worth thinking about.